Today I am on the King Mountain Loop Trail in Larkspur, California, and we just had this big rainstorm last night. And this is like the second or third time we've had a decent amount of rain here in Marin County. And the cool thing is now that we're getting some rain, you can actually see how the forest is starting to change, like the landscape here. Everything is becoming very green, just like a traditional forest. One common complaint I see from people who watch my channel from Florida say, oh, California is so brown, everything is dead, because they don't get a lot of rain here in the summertime. But once the rainy season starts, it actually gets very beautiful here with the colors, and everything just kind of comes to life. But I'll tell you what's not coming to life right now are all the companies who are filing for bankruptcy. In fact, in 2025, corporate bankruptcies are surging. We have 117 large companies that filed for bankruptcy in the past year, which is 44% higher than the long-term average going back to 2005. And in case you don't know what a bankruptcy is, it's essentially when a company has too much debt and they don't have enough income to cover those debts and liabilities. So they are forced to kind of restructure their business. They either kind of go on a payment plan, just like when somebody goes into personal bankruptcy, or they close up shop altogether and they liquidate all their assets and pay off as many of their creditors as they can. There have also been 32 mega bankruptcies, which are companies with over $1 billion in assets who filed for bankruptcy, which is also the highest level since 2020 during the pandemic. The industries that are hardest hit right now are the manufacturing industries and the service industries, making up 30% and 24% respectively of all the bankruptcies, which is more than half. Another way to think about this and look at this is more big companies are failing despite the supposed soft landing economy that we're supposed to be in, because their debt is starting to catch up. And essentially what's happening, or what's been happening for the past few years now, is high inflation and higher interest rates are breaking businesses, because too many business models have been structured around the fact that inflation has been very low prior to the pandemic, and interest rates were also quite low, making it a very favorable environment for companies to come into existence and basically borrow to the hilt until they become profitable. But unlike a person, when they have like a 30-year fixed rate mortgage, for example, these companies will borrow money using short-term loans, maybe just a few years, 3 to 5 years in a lot of cases. And then those interest rates reset, kind of like an adjustable rate mortgage if you were buying a home. And we know these are the key drivers of these bankruptcies because the companies themselves are telling us so. 61% of large bankruptcy filers blamed inflation for eroding demand and raising costs for their business, and 45% of companies blamed high interest rates for making debt unmanageable and cutting off cash flow. Some of the examples that we can look at here are Spirit Airlines, for example. They cited fuel and interest costs plus competitive pricing pressure. Big Lots, they said shoppers have shifted to e-commerce and away from in-store retail. And Franchise Group admitted rising interest rates detrimentally impacted cash flow and their ability to service their debt. So the persistent inflation and the higher interest rate environment are choking the profit margins of a lot of these companies, especially for those that are highly leveraged, which is a lot of them. And of course, higher interest rates and higher inflation cause the consumer to pull back. 58% of major bankruptcies cited reduced consumer demand due to changing preferences or competition. Companies like 2U, which is online education, and Northvolt, which is an EV battery company, both said that interest in their products plummeted after the pandemic. And even brands that thrived during the pandemic boom, like home goods and furniture stores, for example, are now facing a huge drop-off in people purchasing their products, because those are things that people only need to buy every 5 to 10 years. So if you already bought the sofa, you already bought the refrigerator during the pandemic boom, you probably don't need another one. And households are being squeezed because of inflation, so they are prioritizing the essentials right now, and discretionary spending is pretty much drying up across the boards, and it's hitting airlines, it's hitting retail, and it's hitting service businesses pretty hard. And there's a lot of zombie companies out there that rely on short-term debt, okay? And basically these zombie companies don't make a profit, and they have been scrambling recently to restructure their debt and restructure their business model in order to try to stay afloat. But even with all that restructuring, many of them are still going out of business and filing for bankruptcy. And in a lot of cases, creditors are now recovering less than half of the value and money owed to them from these zombie companies compared to a more traditional bankruptcy. And the credit market is not making things any easier right now because the high yield credit spreads have widened sharply in 2025. So bond investors are essentially demanding more yield because they see the cracks forming in the system right now. And they see that the risk is growing exponentially. With all the defaults that are going on and all the bankruptcies that are going on, investors are requiring a higher yield on these bonds to make up for the extra risk, and who could blame them? That's the same reason why we see treasury yields still on the higher side, because people who invest in US treasuries also see the huge risk with the US government and their ability or inability to pay it back, or the possibility of default in the future. And then we have the commercial real estate crisis, which is completely intertwined with this bankruptcy story because office building loan delinquencies hit 11.1% by the middle of this year, which is the highest number that we've seen since the 2008 crash. And it's 6 times higher than it was in early 2023. So this has been getting progressively worse for a while now. So the commercial real estate market is in serious trouble, and office vacancies have been climbing due to remote work, and high refinancing costs are causing more defaults to happen on these commercial real estate buildings. And I've shown you guys already several examples and stories of how some of these buildings are already selling for 60, 70, 80%, sometimes 90% markdowns from what these buildings were sold for just 10 or 15 years ago, which is kind of crazy, especially when you adjust it for inflation. Not only is the nominal number that these buildings are selling for 70 or 80% lower, but when you adjust it for inflation, it's almost like it's free. Check out the view from up here. Also, nearly half of the large bankruptcies cited regulatory or policy instability as a driver, especially in renewable energy and manufacturing. Some examples of this are Sunnova Energy, SunPower, and Global Clean Energy Holdings. They all blamed inconsistent clean energy policies. Wheel Pros and At Home cited tariff disruptions and supply chain volatility. And because there's no clear direction on where these policies or tariffs are going to go in the future, it's causing massive disruptions for these businesses that don't know how to make their next move. But the worst of it has been in manufacturing. We have seen record high bankruptcies driven by inflation and tariffs and policy uncertainty. Also, services sector, you have fewer customers, increased disruption due to AI, and retail is still fragile after the pandemic because we've seen many companies fail. Big companies like Big Lots, At Home, and Joann's have all filed for bankruptcy. Party City was another big one, closing all 700 something stores. A lot of businesses that were doing okay before the pandemic have completely collapsed. And remember, a lot of these businesses have exposure to the commercial real estate market because they're either renting from a landlord who is basically losing the property in many cases, or they own the building themselves and are having a hard time making it profitable to keep, especially when you paid a crazy amount of money for the building 10 or 15 years ago. So this whole notion that we were going to have a soft landing, like the Fed kept promising us whenever they said they were going to take a look at the economy and figure out the correct time to start lowering interest rates, yeah, that seems like it's working out very well now that we're rounding out 2025 and we have the highest amount of bankruptcies going back to 2005, essentially. I think you're going to see more businesses go under over the next couple of years as people continue to be squeezed and have to really prioritize their spending to the point where they're just not going to be able to buy things from companies that it doesn't make sense for. If it's a discretionary expense and people don't have the money, then your business is at risk right now, is essentially what this tells us.